Am I audible? Hello. Good evening, Surendra. Good evening, Varun. Now, am I audible? I hope my voice is clear now. Am I clear? Yeah. Previously, I forgot to add my mic. Now I added. Good. Sorry, actually, last 2 days I was completely down with fever. Now also, but if I keep on delaying, we do not achieve our target. So I am here. Let's discuss model test paper. Now, the following information pertains to Mr. Approve, an Indian citizen and a non-resident. I have discussed this point in NR taxation lecture. Those who are Indian citizen and non-resident in India, they will be called as NRIs. We have discussed NRI taxation. I have told NRI taxation is also very important. So if NRI invests in any foreign exchange asset, from that if any income is received by NRI, investment income, that means either interest income or dividend income, such income is taxable at the rate of 20%. If it is long-term capital gain, it is taxable at the rate of 12.5%. If it is other income, then it is taxable at normal tax. Now, let us read further. Dividend from TPO Limited, an Indian company, gross 1,30,000. See, whatever the dividend income, interest income is there, they will be treated as investment income. Tax rate applicable for NRI is 20% plus applicable surcharge plus health and education cess. Okay. No expenditure is allowed from the dividend income or interest income. They are taxable on gross basis. I have discussed this point in NR taxation revision lecture also. Now, interest on debentures of SLP Private Limited subscribed in convertible foreign exchange of 1,35,000 rupees. See, actually foreign exchange asset means debentures of public limited company. Here it is private limited company na. So this is not a foreign exchange asset. I will show to you also. We discussed NR taxation, right? First concept I have discussed is taxation of NRIs. I have showed foreign exchange asset means shares of an Indian company, private limited or public limited, debentures or deposits with Indian public company. Now in our question, SLP private limited, is it a public limited company? So whatever the interest income is there, that is not from foreign exchange asset. Are you able to understand? See how intrinsically ICAI is testing your knowledge. You should have knowledge to the core, then only you can answer. Okay. Next, he incurred interest on loan taken for purchase of shares of TPO Limited and purchase of debentures SLP Private Limited. See, this expenditure is not allowed as deduction. It is taxable on gross basis. Investment income is taxable at the rate of 20%. I have told you, investment income, dividend or interest, it is taxable at the rate of 20%. Okay. Now, on 15th March 2025, he sold debentures of Fix Limited for 18,25,000 rupees, which were subscribed in convertible foreign exchange on 10th June 2004 in dollars equivalent to 4,65,000. He paid commission to broker. This is nothing but transfer expense. Na? So how much is capital gain? Full value of consideration, how much? Full value of consideration is 4,65,000. I hope you are having material with you. so that you can follow what I am teaching. Okay, full value of consideration 4,65,000. From this we will reduce transfer expenses 7,000. How much is net consideration? Net consideration is 4,65,000 minus 7,000, 4,58,000. Today you have to bear with me. I can teach slowly, I cannot teach fast. Now, from this we will reduce cost of acquisition. I am sorry, they are sold for 18,25,000. Nah, sorry. 18,25,000 minus transfer expenses 7,000. 18,000. From this we will reduce cost of acquisition. How much is cost of acquisition? 4,65,000. So how much is capital gain? Capital gain will be 13,53,000. Sir, from this capital gain, can we claim exemption? Yes, you can claim exemption. On 30th April 2025, he reinvested the sale proceeds of debentures of 4,80,000 for purchase of listed shares of an Indian company. See, whatever reinvestment made, okay, total reinvestment is not eligible for exemption. Proportionate exemption will be allowed. So, how much is net consideration? Net consideration is 18,80,000. Capital gain is 13,53,000. How much is reinvestment? Reinvestment is equal to 4,80,000. So how much is exemption allowed? Exemption is equal to capital gain 13,53,000 into reinvestment 4,80,000 divided by net consideration 18,18,000. How much it will be? 3,57,220. How much is net capital gain that is taxable? Net capital gain taxable is equal to 9,95,772 or 770. Okay. This concept we discussed in NRI taxation. Okay. In revision lecture also I discussed this concept. We are not doing this for the first time. Okay. Now, based on the facts of the above case scenario, choose most appropriate answer to Q1 to Q5. What is amount of dividend taxable in the hands of Mr. Approve? And at what rate TPO Limited is required to deduct TC at source on dividend income distributed to Mr. Approve? We have discussed dividend is taxable on gross basis, and as it is investment income, tax rate applicable is 20% plus applicable surcharge plus HEC. So, how much is dividend income? 1,30,000. So, 1,30,000 is taxable. It is taxable at the rate of 20%. 1,30,000 means it is below surcharge limit now. So, we will add 4% HEC. So, it will be taxable at 20.8%. 1,30,000 is taxable. It is taxable on gross basis. No expenditure will be allowed. As tax rate is very low, 20%, it is taxable on gross basis. So 1,30,000 taxable at the rate of 20.8%. That is the answer. So did you understand? Assuming for the purpose of this MCQ, Mr. Approve is a resident in India. See, if he is resident in India, then it is taxable under income from other sources. And whatever the interest paid for earning dividend income, that is allowed as expenditure. Total interest paid is not allowed as expenditure. 20% of interest or 20% of dividend income or actual interest, whichever is lower will be allowed as deduction. Now, if he is resident in India, how much is dividend income? Dividend income is 1,30,000 rupees. From this, we can claim interest as deduction. How much interest is allowed as deduction? 20% of dividend income or actual interest, whichever is lower will be allowed as deduction. 20% of dividend income means 1,30,000 into 20%, 26,000, or how much is actual interest paid for earning dividend income? Actual interest paid is 30,000 rupees. Okay. So 26,000 or 30,000, whichever is lower means 26,000 is allowed as deduction. Balance how much? 1,04,000 is taxable under income from other source. If he is resident in India, then it is taxable at normal tax rates. Company is required to deduct TDS under section 194I. For payment of dividend, rate of TDS is 10%. So if he is resident in India, then income taxable is 1,04,000 and it is taxable at the rate of 10%. Are you able to understand? See, just because I am explaining to you, it is very easy for you. Okay, if you do on your own, definitely you will commit mistake and it takes lot of time to realize why that particular option is correct answer. Okay, so you have to try, like model test paper 4, 5, 6 are there. Start trying on your own, so you will understand the difficulty. Okay. Next, what is the amount of interest on debentures of SLP Private Limited taxable in the hands of Mr. Approve, and at what rate? Ignore surcharge and cess. See, actually investment was made in private limited company. It is not foreign exchange asset. If it is foreign exchange asset, investment income is taxable at the rate of 20%. What I personally feel is interest income is taxable at the rate of normal tax rates. Are you able to understand? So, how much is taxable? How much is interest income? 1,35,000. From that, how much is expenditure? Expenditure is 20,000. I personally feel 1,35,000 minus 20,000. 1,15,000 is taxable at the rate of normal tax rates. But ICAI did not give that option. ICAI gave the answer like this. ICAI gave answer for third A. Okay, that means answer given by ICAI is Answer given by ICAI is 1,35,000 taxable at the rate of 20%, but I contradict with ICAI answer. ICAI treated here debentures in private limited company as foreign exchange asset, but debentures in private limited company are not foreign exchange asset. They are not taxable at 20% investment income. They are taxable at regular tax rates only, but ICAI gave this answer. I personally feel 1,35,000 minus 20,000. 1,50,000 should be taxable at normal tax. Okay. Here I contradict with ICAI answer. Next, what would be the amount of long-term capital gain taxable in the hands of Mr. Approve? We calculated long-term capital gain. Now, how much is long-term capital gain? 9,95,772 is the long-term capital. Next, assume for the purpose of this MCQ, Mr. Approve is resident in India. For the previous year 24-25, what would be the amount of taxable capital gain? See, if he is resident in India, then this exemption is not available. This exemption is available only for NRIs. But if he is a resident in India, then this amount is taxable. 13,53,000 is taxable. Exemption is not available. The answer for 5 is option A. So everybody, did you understand case scenario 1? Am I audible clearly? Please respond. Now, shall we discuss case scenario 2? Omega Inc., a country F company, maintains an online web platform through which it provides end user computer software through an end user license agreement. So, Omega Inc. is in country F. Omega Inc. It is in country F. Okay. Now, it maintains an online web platform through which it provides end user computer license software for end user. Trailer Limited is an Indian company. So there is another company, Trailer Limited. It's an Indian company. Okay. Now, Trailer Limited entered into contract for 6.7 crores with Omega for financial year 24-25, which is approved by central government. So, like Trailer Limited entered into contract with Omega Limited. How much is royalty or fees for technical services? It is 6.7 crores. And whatever it is there, it is approved by central government. If royalty or fees for technical services is approved by central government, then rate of it is taxable at the rate of concessional tax rate of 20%. See, generally royalty income is taxable at normal tax rate. But if royalty or fees for technical services are received from any contract which is approved by central government, then tax rate is normal tax rates. It is taxable at concessional tax rate of 20%. Okay. Now, the broad terms of EULA between two companies are as follows. Grant of license. Omega Inc. grants Trailer Limited a non-exclusive license to install, use, access, display and run the click-wrap web-based computer software system on a single local hard disk or other permanent storage media of one computer. Trailer Limited should not make CWCS available over a network. This is okay. So now reservation of rights and ownership. Omega Inc. reserves all rights not expressively granted to Trailer Limited in this ULA. The CWCS is protected by copyright and other intellectual property laws and treaties. Omega Inc. owns the title, copyright and other intellectual property rights in the CWCS. That CWCS is licensed only for use and not for any other purpose, not sold. Now, extract of Article 12 of India and Country of DTAA. Royalties and that means what? Here we are going to study about what DTAA in between India and Country F is saying. Okay. Now, royalties and fees for technical services arising in a contracting state and paid to a resident of other contracting state may be taxed in that other state. That means what? Whatever the 6.7 crores is there now. This 6.7 crores, it is taxable in country F. Okay. However, such royalties and fees for technical services may also be taxed in the contracting state in which they arise and according to the laws in that contracting state. But if recipient is the beneficial owner of the royalties or fees for technical services, the tax so charged shall not exceed 10%. That means this 6.7 crores is not mandatorily taxable. This may also be taxable, may also be taxed, but maximum tax rate as per DTAA. Maximum tax rate is 10% as per DTAA. Okay. Now, the term royalties as used in this article means payment of any kind received as a consideration for the use of or right to use of. See, all this is normal information. Based on the facts of above case scenario, choose the most appropriate answer. Okay. Is Trailer Limited India required to deduct tax at source on payment made to Omega Inc? If yes, what is the amount of tax required to be deducted at source on the said payment? See, generally, royalty fees for technical services is taxable at the rate of 20% if approved by central government. But DTAA clearly specifies royalty is 100% taxable in the other country, but it might be taxable in India. Now, as per DTAA, you can understand most of the royalty is taxable in other country. So, as royalty is taxable in other country and it is not taxable in India, as royalty is, see, royalty may be taxed at the rate of 10%, but Indian government did not specify what is the tax rate as per DTAA. Okay, so actually this 6.7 crores is taxable in country X. It is not country F. It is not taxable in India. As it is taxable in country F, no TDS is required to be deducted in India. So answer is Trailer Limited is not required to deduct tax at source. Would Trailer Limited India be required to deduct tax at source on payment made to Omega Inc. if there was no DTAA? See, if there is no DTAA, then tax rate applicable is 20%. Are you able to understand? So, 6.7 crore into 6.7 crore into 20%. How much? 6.7 crore into 20%. 1 crore 34 lakhs. To this, we will also add surcharge because it is foreign company na. So in India, when it is taxable, surcharge is also applicable. Here total income is more than 1 crore na. If total income is more than 1 crore and up to 10 crore, surcharge rate applicable for foreign company is 2%. So surcharge at the rate of 2%. It will be 2,68,000. So how much is tax plus surcharge? 1 crore 36 lakh 68,000. To this we will add HEC at the rate of 4%. 5 lakh 46,720. So how much is tax liability? 1 crore 42 lakh 14,000. So this is the answer. If there is no DTAA, 1 crore 42 lakh 14,720. Next. Would Omega Inc. is required to file return of income for assessment year 25-26 if there is no DTAA? See, if already payer deducts a TDS, then ITR is not required to be filed. Here, already TDS is deducted na 1 crore 42 lakh 14,720. Then not required to file ITR. No, not required to file ITR since if Trailer Limited deducted tax at source on such income. So if TDS is deducted, then if TDS is deducted, whenever TDS is deducted, then ITR is not required to be filed by now. Shall we discuss case scenario 3? See, ICAI is giving answers for MCQs, but it is not giving derivation. That's where student actually feels solving model test papers. Okay. Next. Sharma Private Limited files its return of income for previous year 24-25 on 30th September 2025, declaring loss of 18 lakhs. So how much is loss? 18 lakhs. The rate of income tax applicable to company is 25%. The tax auditor office in his audit report submitted under section 44AB has reported a disallowance 2,80,000 towards that expenditure. See, in our audit offices, we do tax audit na. While doing tax audit, expenditure was disallowed. How much is disallowed expenditure? Disallowed expenditure is 2.8 lakhs. So how much is income? Sorry, how much is loss? 18 lakh minus 2,80,000. Loss is 15.2 lakh. Correct? However, S did not disallow this in computation and return of income. The return of income was processed by CPC, making an addition of 2,80,000. Thereby, loss was computed at 15,20,000. Whenever I am explaining intimation under section 143(1) in assessment procedures concept, I have explained to you if there are any discrepancies between tax audit report and computation of income, then those discrepancies will be rectified by uh, income tax software while processing the return under section 143(1). Here tax auditor wrote the observation, but company computed total income without disallowing the expenditure. Whenever income tax software is processing the return, it disallowed the expenditure and it made loss as 15,20,000 rupees. Are you able to understand? The return of income was, so that means what? As per ITR, loss is 18 lakhs. As per intimation under section 143(1), loss is 15,20,000, 15.2 lakhs. The return of income was selected for scrutiny assessment and by order passed under 143(3), the loss as per normal provisions was reduced to 11,60,000 by making an addition of 3,60,000. See, 143(3) scrutiny assessment was done. As per scrutiny assessment, loss is equal to 15 lakh, loss is equal to 11,60,000 rupees, 11.6. The assessment was reopened under section 147 by order passed under 147. The loss as per preceding order under section 143(3) was converted into income of 3,20,000. So as per income escaping assessment, whatever this loss is there now, this loss was converted into income of 3,20,000. This is the scenario. Now, shall we solve MCQs? Question number 10. Which of the following statements regarding penalty on addition of 2,80,000 towards personal expenditure is correct? See, this 2,80,000 was disallowed na. It was disallowed by not income tax officer. It was disallowed by tax auditor. So with regard to the disallowance of 2,80,000, what are the consequences? See, if income tax officer during assessment finds anything, then penalty will be attracted under underreporting of income or misreporting of income. Here, disallowance is not done by income tax officer. Disallowance is done by tax auditor. So penalty will not be levied. Okay. Since addition of 2,80,000 is adjustment referred to in section 143(1), no penalty shall be leviable. See, penalty will be levied if any addition of income was done under income escaping assessment or scrutiny assessment. As per return processed under 143(1), if any disallowance is there, on that penalty will not be levied. So answer is 3. What is the amount of penalty leviable under section 270A as a consequence of assessment under section 147 if addition was not on account of misreporting? Not on account of misreporting means it is because of underreporting. Okay, because of underreport. So for underreporting, penalty is 50%, correct? So during income escaping assessment, how much is increase in income? 3.2 lakhs minus 11.6 lakhs. So it will be 3.2 lakhs plus, see, minus into minus it will become plus na. So 3.2 lakhs plus 11.6 lakhs. How much is increase in income? Increase in income is equal to 3.2 lakhs, 3,20,000 plus 11 lakh 60,000, 14 lakh 80,000. What is the tax rate applicable? See, it is under reporting. Penalty is 50% of tax amount. Okay, so it is domestic company tax rate applicable is 25%. So how much is tax? 14 lakh 80,000 into 25%. How much? 3 lakh 70,000. To this we will add HEC at the rate of 4%. 3 lakh 70,000 into 4%. How much? 14,800. Total 3,84,800. This is tax amount na. Penalty is equal to 50% of tax. So 3,84,800 into 50%. How much? 1,92,000. That is 1,92,000. Shall we do question number 12 today? So much of cold is there for me. Assuming that additions made in order section 147 are not on account of misreporting of income. If they are but only on account of underreporting of income. S seeks to claim immunity from imposition of penalty under section 270A and initiation of proceedings under section 276C. See, if it is because of underreporting of income, you can request income tax commissioner to reduce, okay, to waive off the penalty, subject to the condition whatever the tax liability is there because of increase in income, the tax liability along with interest is required to be paid and no appeal should be filed against assessment order. If these two conditions are satisfied now, then assessing officer can waive off penalty under section 270A and assessing officer can also waive off prosecution proceedings under section 276C. Actually, application should be made to commissioner. Commissioner will waive off penalty and commissioner will waive off penalty proceedings subject to the condition tax is required to be paid along with interest. No appeal should be filed against assessment order passed under section 147. If these two conditions are satisfied, then in such a case penalty can be waived off. Okay. So pay the tax and interest payable as per order section 147 within the period specified in the notice of demand. Pay the tax as per, see, not only tax, interest is also required to be paid. So tax is required to be paid, interest is also required to be paid. Are you able to understand? No. And appeal should not be filed. So no appeal should be or should have been filed against that assessment order. So the right answer is 1 and 4. 1 and 4. This is the right answer. Shall we discuss question number 13? Now, I'll give you 2 minutes time or 3 minutes time. Try to do this on your own and tell me the answer. Okay, because you also should think na. So try to do on your own. Try to do on your own. This concept we discussed in revision lecture of trust taxation. So you can do on your own. Try to do on your own. Don't look at answer for MCQ. Anyhow, calculation is not given in the answer. I will explain to you. How much is the answer that you got? We discussed anonymous donations concept in revision lecture. We did a problem also. So I think you can do this. Have you done it? Or shall I do? Please respond. Surendra, are you there? Not sure of answer, sir. How can you say like this? Okay, let me solve. During 24-25, Your Care Charitable Trust, registered under section 12AB, received donations of 60 lakhs, out of which 10 lakhs were corpus donations. See, corpus donations are not taxable, na? Corpus donations are like capital contribution, they are not taxable, which were deposited in post office savings bank account. Post office savings bank account means eligible investment under section 11.5. As it is eligible investment under section 11.5, okay, whatever the investment made, that is valid investment only, it is not taxable. And 20 lakhs were anonymous donations. So out of 90 lakh rupees, 10 lakhs are corpus donations. Corpus donations are exempt, na? 20 lakh rupees are anonymous donations. See, anonymous donations are taxable under section 115 BBC at the rate of 30%, but deduction is allowed. Balance 60 lakhs are other donations, correct? Now, let's do How much are anonymous donations? Anonymous donations are 20 lakh rupees. From this deduction is allowed. How much is deduction allowed? 5% of total donations, including corpus donations and government grant, or 1 lakh, whichever is higher. So 5% of total donation or 1 lakh, whichever is higher. How much is total donation? 90 lakhs. Na? 90 lakhs into 5%. How much? 4.5 lakhs or 1 lakh, whichever is higher. That means 4.5 lakhs is allowed as deduction. How much is balance? Balance is 15.5 lakhs. This is taxable at the rate of 30%. Okay. Whatever this 4.5 lakhs deduction allowed is there na, 4.5 lakhs deduction. This will be included in normal donation. So how much are normal donations? 60 lakhs na. So normal donations now. How much are normal donations? Normal donations are 60 lakhs. To this, we will also add this anonymous donation allowed as deduction. How much? 4.5 lakhs. Total 64.5 lakhs. Now, whatever 64.5 lakhs is there, from this standard deduction is allowed at the rate of 15%. Yes, standard deduction at the rate of 15%. How much? 64 lakh 50,000, 9 lakh 67,000. How much is balance? 54 lakh 82,000. This is taxable at normal tax rates, and this is taxable at 30%. Whether default or optional was mentioned in the question? No. Default or optional was not mentioned in the question. In that case, generally we will take default tax rates. Okay. So up to 3 lakh rupees tax amount is nil. Greater than 3 lakh up to 7 lakh, tax rate is 5%, tax amount is 20,000. Above 7 lakh up to 10 lakh, tax rate is 10%, tax amount is 30,000. Above 10 lakh up to 12 lakh, tax rate is 15%, 2 lakhs into 30,000. Above 12 lakh up to 15 lakh, tax rate is 20%, 3 lakh into 20%. Above 15 lakh, tax rate applicable is 30%. So 54, 82, 500, 15 lakh into 30%. Much? 11 lakh 94,000. How much is tax? 13 lakh 34,000. On 15 lakh 50,000, 30% tax is applicable na. 15 lakh 50,000 into 30%. 4 lakh 65,000. So how much is total tax? 1799,750. To this we will add HEC at the rate of how much? 71,990. How much? 18 lakh 71,007. This is the answer. Oh, I am sorry. Here I did one mistake. From 54 lakh 82,500, How much is applied for charitable purpose? 40 lakhs is applied for charitable purpose towards its objectives. So whatever the amount applied for charitable purpose, that should be allowed as deduction. Less amount applied for charitable purpose. How much? 40 lakh rupees. So how much is taxable? 54, 82, 500 minus 40 lakhs. 14 lakh 82,500 is only. See, sometimes our mind is absent, just like how I am today. We will make calculation wrong. Up to 3 lakh. Greater than 3 lakh up to 7 lakh, tax rate is 5%. Tax amount. Above 7 lakh up to 10 lakh, tax rate is 10%. 30,000. Above 10 lakh up to 12 lakh, tax rate is 15%. Tax amount is 30,000. About 12 lakh up to 15 lakh, tax rate is 20%. That means 1482,500 minus 12 lakh into 20%. See, whatever I do, you are also doing it. You did not find the mistake which I did. Very sad. 56,500. So how much is total tax? 1,36,500. Now, tell me 136,500 plus 4,65,000. Total 6,01,500. To this we will add HEC at the rate of 4%. 24,000. 6,25,560. This is the. So did you understand? See, this question was asked for 2 marks. This should be 8 marks question, but he gave it as MCQ. I say intentionally wants to kill your time in the examination. That's why I say he's doing. Now, shall we discuss question number 14? Mr. Sugam, a resident Indian, aged 61 years, has income of 48 lakhs under PGBP. One of his business is eligible for deduction at the rate of 100% of profits under section 80 IB for assessment year 25-26. The profit from such business included in the business income is 20 lakhs. What would be the tax liability computed in the most beneficial manner of Mr. Sugam, assuming that he has no other income? See, first we will calculate under default tax rates, then we will calculate under optional tax rates. Under default tax rates, deduction under section 80 IB is not allowed, correct? So, how much will be his income? 48 lakh rupees. Under default tax rates, whether deduction under section 80 IB is allowed, deduction under section 80 IB is not allowed. Total income is 48 lakhs and he is resident individual aged 61 years. Even though his age is more than 61 years, still basic exemption limit available under default tax rates is only 3 lakhs, correct? So, let's calculate tax liability under default. Up to 3 lakhs nil. Greater than 3 lakhs up to 7 lakh, tax rate is 5%. Tax amount is 20,000. Above 7 lakh up to 10 lakh, tax rate is 10%. Tax amount is 30,000. Above 10 lakh up to 12 lakh, tax rate is 15%. Tax amount is 30,000. Above 12 lakh up to 15 lakh, tax rate is 20%. So 60,000 tax. Above 15 lakh, tax rate applicable is 30%. 48 lakh minus 15 lakh in 30%. 9,90,000. So how much is his tax? 11,30,000. To this we will add HEC at the rate of 4%. How much? 45,200. So tax liability is 11,75,000. This is under default tax. See, these are not like MCQs. These are like full length answers which are asked for just 2 marks. Now shall we calculate under optional tax rates? Under optional tax rates, deduction under section 80IB is allowed na. So how much is total income? Total income is 48 lakhs. From this, we will claim deduction under section 80IB. How much? 2 lakh rupees. Balance 46 lakhs. Sorry. 20 lakhs na. 80IB is 20 lakhs. So 28 lakh rupees total income. On this we need to calculate tax liability. He is resident individual aged above 61 years. So basic exemption limit available is 3 lakhs. Up to 3 lakhs, tax amount is nil. Greater than 3 lakhs up to 5 lakh, tax rate is 5%. 2 lakhs into 5%, tax amount is 10,000. Above 5 lakhs up to 10 lakh, tax rate is 20%. 5 lakh into 20% tax amount. Above 10 lakh, tax rate applicable is 30%. So 28 lakh minus 10 lakh into 30%. How much? 5,40,000. So how much is tax? 6,50,000. To this we will add HEC at the rate of 4%. 26,000. How much is final tax liability? 6,76,000. But under optional tax rates, AMT provisions are applicable. If you remember, if there are 3 deductions, deduction under section 35AD, deduction under section 10AA, deduction under section 80IA to 80RRB, whenever these 3 deductions are there, AMT provisions are applicable. We need to calculate adjusted total income. So how much is total income? 28 lakhs. To this, we need to add back deduction under section 80IB. How much is deduction under section 80IB? 20 lakhs. How much is adjusted total income? 48 lakhs. On this AMT is 18.5%, correct? 48 lakhs into 18.5%, how much? 8,88,000. To this we need to add HEC at the rate of 4%. How much? 35,520. 8,88,000 plus 35,520, 9,23,000. So this is alternate minimum tax. And how much is normal tax? Normal tax is 6,76,000. Out of these two, whichever is higher means 9,23,520. So under optional tax rates, tax amount is 923 520. Under default tax rates, tax amount is 11,75,200. So where tax is lower? Tax is lower under optional tax rates. So it is advisable to choose optional tax rate. 923 520 is the answer. See, this he gave for 2 marks. Now shall we discuss question number 15? Mr. Sahil set up a 3-star hotel. 3-star hotel means it's a specified business, na? Specified business. In Bhopal on 16th May 2009, and another 3-star hotel, Greenview, in Mumbai on 1st April 2012. See, this is also 3-star hotel. Sahil is there. Sahil is having 2 hotels. First, hotel number 1, Cloud View. Another one is Greenview. Hotel 1 is specified business. Greenview is also specified business because both are 3-star hotels. As they are 3-star hotels, they are eligible for, they are treated as specified business. But when Cloudview was incorporated, it was incorporated on 16th May 2009. That means before 1st April 2010. As it was incorporated before 1st April 2010, deduction under section 35 AD is not available. Deduction under section 35 AD not available. This was incorporated on 1st April 2012. That means after 1st April 2010. Na? So is it eligible for deduction under section 35 AD? Yes. It is eligible for deduction under section 35 AD. Now, both are specified businesses only, but later business is eligible for deduction under section 35 AD. Here, see, Mr. Sahil has profit from Hotel Cloudview 95 lakhs and loss from Greenview 35 lakhs. So, from this business, there is profit of 95 lakhs. From this, there is loss of 35 lakhs. Now, the thing is, whether this loss can be set off? Yes, it can be set off. See, if both are specified businesses, sufficient. There is no such requirement that both should be eligible for deduction under section 35 AD. Even though later business is not eligible for deduction under section 35 AD, still you can do set off. So, net PGBP income is equal to 95 minus 35. So, this is in case of Sahil. Did you understand? His brother Akhil is in the business of building and operating hospitals. So there is his brother. His brother name is Akhil. He is into hospital business. Sahil is into hotel business. Brother is into hospital business. Now he set up a hotel, Lifeline, with 50 beds capacity. See, 50 beds capacity means, is it eligible for deduction under, is it a specified business? No. Any hospital containing minimum 100 patient beds, then only it will be treated as specified business. Are you able to understand? So let's say there is hospital Lifeline having 50 patient beds. Now, is it a specified business? This is not a specified business. Next. So if it is not a specified business, 35 AD deduction is also not available. Next, which begins to operate on 1st August 2008, and another hospital, Life Care, with 120 patient beds. 120 patient beds means it is a specified business. So there is another hospital, Life Care, consisting of 120 patient beds. So it is a specified business. Now, when it was incorporated on 15th May 2016. 15th May 2016. That means on or after 1st April 2010. So this is also eligible for deduction under section 35 AD. Now, Lifeline has profit of 54 lakhs and Life Care has loss of 25 lakhs. How much is profit? 54 lakhs. Loss 25 lakhs. Now, can this loss be set off against 54 lakhs profit? Not possible, because it is not a specified business. Specified business loss can be set off only against specified business profits. So what is the answer? 60 lakhs is taxable for Sahil. So 60 lakhs is taxable for Sahil and 54 lakhs profit for Akhil, 25 lakhs loss for Akhil. Yeah, 54 lakhs profit, 25 lakhs loss. So the correct answer is A. Did you understand? So I discussed all the MCQs. I gave derivation for answers of all MCQs. Descriptive questions are there. My kind request today, please go through descriptive questions. Answers are also available here. Please go through the answers also. Whenever you get a doubt with regard to any answer, please ask me in my Telegram group, or you can ask me in my WhatsApp also. Number is available on website. So today I am not feeling well. I hope I have given answers for all MCQs where majority of the students suffer, because students does not know how ICAI arrived at that answer. So I gave derivation for all answers for all MCQs. And descriptive questions, you please go through them now itself. If you have any queries, please ask me in my Telegram group or in WhatsApp. What Monish is saying, time is a crucial factor in direct tax. Yes, very much crucial factor. In case of MCQs, you need to do rough work. In rough work, in a quicker way, in less time, you have to arrive at the answer. If you do slowly, actually 8 marks question is being asked for 2 marks MCQ. That is not fair, but those are all ICAI things. Okay. So please go through the answers. Thank you very much. Again, we will meet tomorrow. I will update in Telegram group. Thanks a lot for your support, for being patient till now. Thank you. Bye. Good night.